Okay, this video covers taking financial statements and recreating the inventory T account. And what inventory are we talking about today? We're talking about Duluth Trading Company. So we're talking about suspenders and jeans and socks and the type of clothing you'll wear when you finally give up your fast-paced MBA lifestyle and go back to the farm and go back to your roots. So that's the inventory we're talking about. And let me show you Duluth's financial statements, because Duluth is a public company. So you can find their financial statements on the SEC's website. And here I've pasted a portion of their balance sheet, the current assets portion, and a portion of their income statement, all the way down to operating income. And the task we're going to do is we're going to recreate the inventory account. Now, inventory is an asset account, and so it has a beginning balance of a debit. Then when the company buys or produces new inventory, say they buy inventory with cash, the company, Duluth gives cash to a supplier and the supplier gives them jeans and socks. Well, they'll debit the inventory account and they'll credit cash in that transaction. And so this additions here is the debit to the inventory account. Then when Duluth sells inventory, say they sell it for cash, it's a debit to cash and a credit to revenue for the sale. And then you have to also take the inventory off your balance sheet. So it's a credit to the inventory account and a debit to cost of goods sold. So here is the credit to the inventory account, and the debit to cost of goods sold shows up right here on the income statement. Okay, so let's fill out this T account now. And by the way, this T account, and you can think of any T account this way, think of it as a bucket. A bucket has some beginning amount of something in it. You add stuff to the bucket, you take stuff out of the bucket, and it has an ending amount. And so you can think of any T account just as a bucket with things going in and things coming out. So first of all, what is the starting and ending points of our inventory bucket? Well, we can find that on the balance sheet. This right here is the inventory balance. And this is this year's balance, 147,849 is the current year balance, and 97,685 is last year's balance. So 97,685 is going to be the beginning balance, and 147,849 is the ending balance. Okay, now we know what the cost of goods sold entry was, don't we? It's a credit to the inventory account and a debit to cost of goods sold. So there's that debit to cost of goods sold, which is 287,475. We could plug that in right there. And now it's just a matter of solving for additions. So the company's not disclosing additions anywhere. You just have to solve for it using this T account. So this is an equation. It's an equation with one unknown. Beginning balance plus additions minus cost of goods sold equals ending balance. And if you solve for additions here, you get 337,639. And I would recommend when you do this type of an exercise, just calculate it through and make sure it worked. So on your calculator, take 97,685 plus 337,639 minus 287,475 and make sure that you get 147,849. And that is it. So what we did was we took information from the balance sheet and income statement and we recreated the inventory T account. And that was pretty fun. And I'm sure we'll do this a lot more. And I'll see you on the next video. Bye-bye.